Thank you so much for joining today's seminar on who should I trust with my money. I couldn't be more pleased to talk about the challenges of working with wealth managers and the challenges of us making our own financial and investment decisions. So we're going to kick off in just a second. Okay, let's kick off. So I'd like to start off with a story, a true story from about 30 years ago. So this kid walks into a bank and he asks, where should I put my money? So this is money he's been working, mowing lawns, whatever. And just like most adults do, he thought, well, maybe I should put it in a savings account. But there was a sign there, and the bank teller said, well, you know, there's this thing called a certificate of deposit, and it gives you more interest. And so the kid says, well, what's interest? She says, well, interest is the money that we pay you for putting the money in our bank. He says, oh, okay, well, why are you paying that much more for the certificate of deposit than checking account? Because my mommy puts money in the checking account. She says, well, certificate of deposit gives higher interest because we hold the money. It's a little bit harder to get it back, but you can get it if you want it. You just give up the interest. He says, okay, well, I don't need the money anytime soon, so I'd like to get more of this interest stuff as much as I can. And he says, yeah, I'm interested. I want to do this the CD. So this early experience may have shaped this young boy's life because he got this early exposure to this idea of yield and this idea of delaying gratification. We'll talk about that later. So this talk is based on the belief that we can invest and build wealth on our own. The question is, well, who should we trust along the way? Because it's seldom that we make decisions by ourselves. So we often will work with either someone within our house or we have financial professionals that work with us. So among financial professionals, should we trust them? What are their incentive structures? Are they going to make us ultimately better off than we would be if we made decisions on our own? These are some big questions we have to think about. And so the do-it-yourself approach of making your own financial investment decisions is one that you have to consider because the do-it-yourself approach has big benefits, but there are also big drawbacks because you don't have the support of a professional. But if you know the lay of the land, you know the pluses and minuses and all the research behind self-directed decision-making, you can be very successful. And most people think it's much more complicated than it actually is. So let's take a look at some of the big kind of landmines and challenges that people run into and how we can avoid them. So why bother? Why bother? Because there's some big prize if we do it right. Here, what we're looking at is a graph that shows the performance of somebody putting $5,000 a year for the last 30 years. And if they had put that in and saved that money, like, let's say, under the mattress, the dollar value decreases over time because inflation eats it away. And so the real cash value, putting $5,000 away, the true value of it is actually just over $100,000, while the nominal value, the dollar amount, is $150,000. So you can see there's a big loss because inflation eats away your buying power. If somebody invested in what's called fixed income, like bonds and treasuries and these kinds of safer assets, they would have made almost $400,000 over that period. So that's a lot more than just having it sitting in cash. And this is considered the safe way. Now, putting the money in what we call typically the market, like putting in the S&P, the Standard & Poor index of the 500 largest companies by market cap, it's a common benchmark. And the performance of that is much higher. As you can see, sure, that line is much more jagged, volatility, and that's scary to people and shakes people out of making good decisions. But that's a lot of money. And what us academics call it is this liquidity premium puzzle. And it's wondering why people don't participate in equities. And that gap is pretty big. That's a very big difference between those two amounts. And as economists, we call it opportunity cost of capital. You could put the money in the S&P, you could put it in fixed income, or gosh, don't invest it at all. Well, your capital has an opportunity cost. So thinking about the magnitude of difference between these different choices that we make as we go through life is important. Putting a dollar value to these risks or these things that we do or avoid doing. Let's talk about inflation for just a second. $10,000 at the beginning of that timeline would be worth less than $5,000. That's a big erosion of your buying power, of your purchasing power. So the motivation to invest becomes higher when you know that your money is going to decrease in value over time. So the roadmap for today, we're going to talk about, we'll talk about professionals and talk about the research around them, and we'll talk about protecting your interests. That's really the main point here. We're not asset managers at Prof of Wall Street. We're looking out for the best interests of investors and empower them to grow their wealth over time. The next part is, well, should I trust myself with my money? And well, it can be simple, but people make it really complicated. There are ways to get to that wealth level without super sophisticated approaches or lots of day-to-day effort. So where we struggle, if we can identify where we struggle, we could possibly avoid those mistakes, and then resources for you. So that's the roadmap for today. And let's dive into, well, before we dive in, who am I? I'm Amos Nadler. I used to be an academic. I was a professor for about 10 years at the Claremont colleges and at Ivy Business School. And the reason I'm not an academic and why I worked in wealth management and at a hedge fund and then started Prof of Wall Street is because there's incredible research in behavioral economics, behavioral sciences, that if they were correctly productized, it would elevate normal people to be superhuman investors. And that's really my passion, is taking research, productizing it into behavioral finance, into what's called behavioral fintech rather, and taking normal people and empowering them to make better decisions, improve their wealth in a scalable way. So we have a quiz we'll start on now. So let's kick off.
Recording stopped.
Great. Thank you, Lexi. So the first part of this is, should we trust financial professionals? Now, in sort of full disclosure, my approach to this really came initially as an academic. And there's like a short backstory, which was I was a professor at a business school, and there was a massive study being done across one of the big financial advisors, which obviously I can't mention. And they found basically some results, and the results were not good. And I was expecting that when these results got published, there would be this like huge splash and lots of news and all of that. And not so much, which relative to the gravity of the findings, I was sort of surprised that it got very little attention. But then I started thinking about it, and I thought, well, an industry that relies on this particular incentive structure would probably not want to feature it. MSNBC would never feature this paper, or any other kind of financial news. Although I would say the Wall Street Journal probably would. I would say I give them credit for these kinds of things. But the paper essentially just showed, this is a paper you can download. It's called from the Journal of Finance. It's like our top journal. And retail financial advice, does one size fit all? And basically what they found, there's two papers that came out of this big data set. One was that advisors were making recommendations that were pretty common across people and were more representative of the advisor than the specific people's needs. So not a lot of customization. We'll talk about some sort of like the red flags of financial advising, and that's being one of them, this one size fits all. The other part that was really interesting was that the advisor's portfolio looked a lot like what they were advising. And if you think about the mismatch, let's imagine you're near retirement, and this advisor could be in their 20s, and this particular person's risk preferences and exposure to asset ideas is very different from somebody who may want something that's maybe more conservative. So the kind of comparisons are endless, but the danger is pretty serious that if someone's thinking in a way that's different from someone later in life, then the recommendations are going to be inappropriate and incommensurate with their risk level, the risk appetite, risk capacity, and asset appropriateness is not going to be there. So it really came on my radar, and I was starting to think that something should probably be done about it. And it wasn't until Prof of Wall Street sort of got deeper and deeper working with people and talking to individuals about what's actually happening with their advisors that not just validated what was in the paper, but actually was like way worse than what was in the paper. So not trying to like be alarmist or anything, but we've looked at some data and people generally don't know what's happening with their accounts. But the point here is to empower you to do due diligence, know what's going on. So let's keep rolling. So the world of financial advice is a very big world. It's a professional space filled with lots of different people. As we see here, there's registered financial advisors, which are like a legal term in the United States, which is different from a financial advisor, and they have different standards. And the list goes on. There's wealth planners, there's commodity trading advisors, accountants like your CPAs, and on and on and on. Just in the interest of time, the focus here is going to be really on a subset of these financial professionals, of financial advisors, as we typically think about them. You walk into a big shop, think about it, Schwab or Merrill or TD or whatever it is. We're talking about these guys. We're also talking about independent wealth managers as well. We do have a blog post that goes into great depth about most of these, so please check it out. It's on profofwallstreet.com, and it's pretty well researched and talks a lot about the incentive structure and understanding what it is that you actually need. Why are you going to an advisor? So let's look at the research. So this paper just came out of Harvard just late last year, and it found that 7% on average of financial advisors had some sort of misconduct. 7% is kind of a lot, and in some jurisdictions it was up to 17%, which is really a lot if you think about that. And this is Egan et al. Came from HBS. So the good news is that after these firms were publicly sort of shamed and named about it, misconduct dropped. And so by making the market more transparent and making the violations transparent, then people just shape up and avoid these sort of major mishaps and minor mishaps. So again, shaming, not that we want to shame people, but we do want to bring transparency if people are being harmed. As I was preparing for this talk, no joke, this popped up in the news that there was an advisor not very far from where I'm sitting right now who basically stole about $5 million from their clients in like very, very illegal ways. Not like, oh, they recommended a mutual fund instead of an ETF. It was like very bad. So the point here is that it happens more often than you think. These are only the ones that have been caught. And there's lots of small misconduct cases or small cases of misconduct rather that are never reported or never understood. And so it's really up to us to take care of our own interests. Another fact, this is from research, is that essentially no financial advisors beat the benchmark. This is from the data sets that I've looked at, from the research that I've read all these papers. That doesn't mean that your financial advisor or your specific portfolio doesn't beat the market. It's certainly possible, and we tend to be obsessed with benchmarks. But in general, gross of fees, and this came from the same study I mentioned earlier, gross of fees, individuals are significantly underperforming the market, whether it's because of the asset selection, the churning on their account, which we'll talk about in a second, or just whatever it is that's going on, they're not making any economic profits from that relationship. There's lots of benefits to financial advisors, as I mentioned before, financial planning and hand-holding, and there's lots of good things that come from it, but just by and large, don't expect to walk in. It's not a hedge fund. That's not generally the purpose. And most financial advisors show biases in poor active portfolio management. I can say, as someone who worked at a quantitative hedge fund, ran research, ran basically the quantitative process of that fund, active management is very difficult. And Prof Wall Street specializes in analyzing trade data to identify biases. And we get our hands on data, we find unbelievable bias, we find strong kind of tendencies that people have that they don't know about. And so this isn't meant to be sort of attacking unfairly. This is not just true of advisors, also professional fund managers who are managing billions of dollars do the exact same thing. Us as individuals do the exact same thing, but it's not until we can identify it that we can improve. So I'm not just trying to pick on them, just looking at when you trust your money to someone who you think, and I hear this all the time, well, they know more than I do. Well, they might, but the ability to do what you think they're doing is probably not there. Minimal customization, that's another kind of red flag, is that, yeah, cookie cutter, yep, come in, thanks for your money, I'm going to put you in this, see you later. And I know that's not true for everybody, and I've spoken to financial advisors, and I think some of them have even signed up for this call. I know personally they do their absolute best to customize, to understand the individual. They take inordinate, like massive amounts of time to interview them, to know what's going on. And so this is not a blanket statement by any stretch. But by and large, largely because of the incentive structure, the customization, especially for small accounts, like under $1 million or so, they don't get the attention that they deserve. Let's talk about fees. This is a simulation of the same portfolio we looked at earlier. This is just all in the S&P. And now if you took off 2.5% of fees off the portfolio, that's the difference in how much money you'd have. Now, an advisor might say 2.5 these days is lower. There's been a compression of fees, and that's totally true. I'm borrowing that number from that paper. You could drop it to 1.5. But over long periods of time, the impact of compounding really makes a huge difference. So even though 2.5% sounds like nothing, over a period, especially when the S&P is doing really well, you're shaving off 2.5%, you're reducing the compounding, huge cumulative effects. Humans are not good at that. It's called exponential growth bias. We're not good at understanding the impact of compounding. We just think it's all linear, and that's a real critical part that we have to understand as people, the effect of compounding. So this slide actually came from a paper this is a real estate paper. This was it came out, I think, when I was a PhD student, and it talked about why is it that real estate agents spend more time and they earn higher returns on their homes versus their clients. This was a very cool paper that came out, and it basically showed the following, that if you look at the amount of effort required to negotiate for just like another 2% on a house, it takes time back and forth, terms, this and that, well, they could spend that same amount of time just selling another house. And so what was found is that agents, again, not picking on agents, just talking about the incentive structure of the profession, the incentive was to get the deal done quickly and spend that time closing more houses. And that paper came up when I was preparing for this presentation. I thought, well, let's do something similar. Let's calculate the incentive to improve your performance, let's say by 200 basis points, by 2%, and then compare it to getting another account of a similar value. I think it was about $1 million. So for the same individual to improve their performance by 2% is about $200. But if I spend that same amount of time doing marketing and sales, massively bigger upside from that new account. And that's really the incentive structure that they're faced with. So this is just in gross revenue. We know that that's not necessarily what they take home, but the incentive structure has been historically not there, although I'm seeing a lot of advisors being much more sensitive to this, advisors wanting genuinely to do a better job and willing to spend for it. And there's a lot of reasons for that. Transparency is a big part of it. But historically understanding that you just want more book, you want more wallet share. But the way to get wallet share is changing, and we could talk about that if we have time at the end. If there's one word you take away from this, is the word fiduciary. And I'm looking at the quality of people on this call. I know a lot of people might have heard this word or know this word or use it every day, but the meaning of the word fiduciary has a legal implication. It means that the provider must act in accordance with the client's best interest. So that might even be in opposition to the advisor's best interest. So a fiduciary like an RIA would have a client in his office or her office, and they say, well, I could sell you this mutual fund and get this fee associated with it, or I could sell you an ETF that has the really same return profile, it's essentially the same product, but a much lower fee. Well, is it in the client's best interest to do that? Or this insurance product that makes absolutely no sense for this person, but I get commissions, so I'm going to do it. There's some legal guidelines around this. So somebody acting on your behalf with a fiduciary approach, even if their firm doesn't require them to have fiduciary duty, is critical for you. So we have a resource we'll give you. It has the fiduciary pledge, and it's a PDF that I would offer you, show your advisor if you have one, and see how they respond to signing a pledge that means I'm going to do what's best for you even if I don't get the commissions from it. That's the kind of person you want to work with. And there are people like that hold themselves to those standards, like over and above the legal standards. So again, not in any way trying to trash advisors, just equipping you with the language and the tools to make sure you're getting what you need. So some of the red flags, these are covered in depth. We have a blog post about this, so we don't have time to go deeply through all of them, but there's some pretty concerning things. Churning is the one that we're really experts at Prof of Wall Street. If we get the trade data, we can determine whether somebody's churning, which is like trading a lot and essentially losing money because they get fees for trading. And we recently looked at somebody, and not to be alarmist on this, but they lost 45% of the traded capital by trading, just buying and selling stuff on someone's account. Client was not happy. But who checks on this stuff? It's really been hard historically to do that. Now we're empowering that. So here's some of the red flags. You could argue some of them are appropriate, but these are generally things that you don't want to be dealing with, or at least make your own decisions about high fee products specifically. If you want to check if your specific advisors had a history of violations, go to brokercheck.finra.org. This is for the US, and take a look. Just for fun, I looked up Bernie Madoff. That was an interesting page. Hopefully no one worked with him. Just on the flip side, there's also green flags. There's characteristics and traits and behaviors that are fantastic that you see from advisors. So acting as a fiduciary consistently, that's critical. Look at this whole list. These are traits that I see in people, and if you're working with someone, great, you may already be set up for it, but it's just important to understand what some of the red flags are, what are some of the good traits that advisors have. And again, this is on the blog post on our website, so please take a look at it, read it, follow up if you have any questions, and the PDF has a lot of this in it. Okay, so to sort of sum up this section, when we're looking at financial professionals, which I know this is a massive space with lots of different kinds of advisors and skills that you could get, the first part is identify what your specific needs are. Because if you have an unclear need just to walk into an advisor, especially at the big shops, and you can't articulate what your needs are, then it's hard to find the right match. So what you might need is an estate planner, but you walk in and ask for a financial advisor, and they may not refer you out because of the incentives of getting your money. So first square up on what your specific needs are. That's just like knowing the lexicon and being clear what the biggest challenge you face is. Ensure your incentives are aligned, as we talked about previously. There's incentives for sales, incentives for commissions, and the incentives aren't necessarily towards customization or improving performance. So incentive alignment is always critical. And again, the blog post, we talk about kind of one by one how incentives are aligned for each type. Do your own research. Like as I said, check out BrokerCheck, ask for referrals from advisors you might work with. There are ways to avoid some of the big pitfalls. And then select what seems best and review. There's no way to know perfectly. There's always going to be uncertainty with whatever choice you make. But if you have some process for selection and for assessment, you'll do better than most people who just like walk into a shop and say, take care of my money. So putting you in the driver's seat is really critical. This is the resource I mentioned earlier. We call it the Wealth Management Evaluation. It's the checklist, and so it has a checklist, and then there's a fiduciary pledge right in there, and I think there's a zoomed-in version of it here that shows. So there's categories of such as performance, there's service, qualifications, compliance and legal, high-risk factors. These are things that are generally not talked about. So what we try to do is concentrate it into like one document to empower you to have those conversations and just, hopefully you'll have the conversation. Honestly, people sometimes just shy away from it because they're uncomfortable. Oh gosh, I really like my advisor and I don't want them to feel uncomfortable. I hear that often. It's your money. And if you're not going to be proactive about it, there's a really low probability they'll say, you know what, I'm not going to do what's best for the firm, because everybody has pressures. They have job pressures. And if you advocate for yourself, you're probably going to get a better outcome. So now we're on to the second part of should I trust myself with my money? The first part was financial advisors, professionals. Should I trust myself? Right. I was thinking of saying, I hope you're enjoying the quiz, but maybe that's just like a leftover of being a finance professor where you torture people with quizzes. I hope it's informative. Enjoyment might be too strong of a word here. I'm well aware of that. Okay, so this is about us. This is about us as individuals, largely unsupported by a professional. There's lots of resources that we'll talk about. Let's talk about what lies ahead as self-directed decision makers. So the reality is that we spend more than we make. There's a fairly significant amount of household debt in the United States. Canada also has had an increase in household debt. And the question becomes why? The simple answer is that, as I mentioned, we spend more than we make. There's different types of debt. So we have mortgage. Most people have a mortgage. A lot of people owe on their cars. People have credit card debt. There's like student loans. There's lots of different types of debt. And by the way, not all debt is bad. Like, just put that out there. It's specifically like high interest debt, buying things we don't need. And every person needs their own determination of what's the right amount of debt for their household. It's not just it's like bad across the board. But I want to spend a little bit of time on the household finance aspect of things before we talk about the investing part, because if you don't have good household discipline, you're not going to have money to invest. Or if you have massive interest-bearing debt, then going out into the market investing while you have that money to pay that off, probably a bad idea. I feel like Dave Ramsey, by the way, right now with this like mic and this setup. So I think he says the same thing. I've actually never listened to Dave Ramsey, but he actually has good impact on savings rate. There's a study that showed the Dave Ramsey show actually increased savings rates across households. So good stuff. So there's a lot of reasons why we go into debt. Currently, inflation's been a hot topic. Inflation's outpacing wages and wealth. Beta delta preferences is basically the kind of behavioral econ nerd way of saying that we really like things now and we don't like things later. And so we struggle with that as humans. It's a trait that makes us human. On the flip side of like what's called present bias is this idea of future mindedness. And there's a paper that just came out a few days ago looking at how intergenerationally you can pass on future mindedness. So grandparents, parents, kids, and how these ideas of caring about the future and making sacrifices towards a better future actually transmit through the generations. So I think that's quite true. And so to think about that in our own family, in our own culture, in our own church, synagogue, whatever you do, like thinking about that future mindedness versus the here and now, that's all that matters. That's a critical trait. Easy credit, hard marketing. We all know what that's all about. Social comparison. People are quite sensitive to social comparison. I found it to be true much more so in California, much more in Southern California, and much less so in other parts of North America. And there's certainly macro factors. So a lot of reasons why we have big household debt. Moving on, another problem is literacy. So this study looks specifically at Americans. Canadians also score quite poorly on this specific test. It's 3 questions, talks about inflation and interest, topics we've already covered. And they tend to do a bad job at this quiz. If we had more time, we would, again, torture you with a 3rd quiz. But the question is, why is it that people are so bad at these 3 questions? Or there's like an abridged, another one that's like 7 questions. And it's not an educational priority, and it's not intuitive. So because of those 2 reasons, people just continue to make bad economic decisions because it's not taught early. And the fact that our kind of gut reaction leads us to make these decisions, not just in savings and spending, but also investing, we think it's right. But like, as we'll see later, an emotion is not a trade signal. We are working potentially with a group in Chicago, helping out with like school-age kids to inculcate good habits and kind of undo some of the patterns that you see in that specific demographic, to see if we can they can make better decisions and kind of move their trajectory to higher socioeconomic status. So spending and saving, this is a bit of a checklist. It's a bit deep. I'm not going to go through it in great detail, but these are just some of the basics about a budget. Reducing unnecessary expenses, which means making the effort to review your expenses, putting cash in highest interest earnings accounts. There's a company called maxmyinterest.com. I know the founder, Gary. I have no financial interest in it. But what they do is great. They just find the highest interest account that your money could be in at any given time, and they take a few bips off the top. It's effortless on your part, and I think they're only operating in the US. He's from London, Ontario, of all places. So my wife is from there as well, and Gary's a great guy, and I like supporting what he does, because if your money's just sitting around, you might as well earn the highest interest you can. Housing costs, there should be a ratio. Look to optimize retirement accounts. There's this whole study I did looking at retirement decisions by large university employees, and found that people that were eligible to get free money from the university, they would not take it. And one of the traits, one of the kind of phrases we heard a lot was take-home pay. Don't touch my take-home pay. So this idea of being very protective about income, while passing up sometimes massive matching grants, like 7.5% free money that you'd get from your paycheck. And again, that whole like future mindedness versus now, that was one of the problems that we went through. And then having a rainy day fund, the thing that people don't understand until they're in the situation is we make our worst decisions under duress. And why people talk about it and very few do it is we never think it's going to happen to us. But people lose their jobs, people get injured, lots of bad things happen. And the worst things that we do, like selling assets or whatever, happens in emergencies. So if you can have some sort of liquidity for those bad situations or some type of insurance in place, you never want to be in that situation without it. And then paying off your credit card balance. I know it sounds like Dave Ramsey or Susie Orman, but if you don't have the good fundamentals, we don't get to the fun stuff, which is investing, which is what I want to talk about next. 45% of North Americans don't invest at all. Like not in their retirement, they don't have a self-directed brokerage account, they don't have a financial advisor. That's a lot of people. We can ask the question, why? And here I'm going to focus specifically on self-directed investing. We spent a good amount of time talking about financial advisors. So this came from a paper that was just released at the end of last year, and it talked about how non-investors perceive this very high entry and participation cost. So the entry cost is, oh gosh, I have to know all this stuff to even get into the market, and participation cost, well, I have to watch it all the time. I've got to pick the right stocks. I've got to be like on it like a day trader, but my job, I'm a dentist or I'm a whatever. Like I don't have time for that stuff. So there's some misconceptions about what you could do, or misconception about what's necessary to be a self-directed investor. Now, while it's true that you could generate alpha through their specific services and newsletters and platforms that could provide you with that, but you don't have to do that. So there's this misconception among both non-investors and investors about how involved you need to be to have long-term positive returns. So this is the why bother that you saw earlier. And like that's a big difference. Sitting in the S&P can be terrifying. I get it, especially what's going on now. But to develop the competence, the equanimity, the tools, the ability, or use the tools, which I'll show you in a second, it pays off. It has like a massive payoff. Human capital, getting educated and having that is one of the biggest areas of growth for people. But like having the skills to be a long-term investor is something that can differentiate you as well. So not just getting, a law degree or MBA or whatever it is, like that on top of other good financial decision making puts you in a very, very good situation. And you don't need luck to do that. So that's that big gap I was talking about, where you can do this. You can do that yourself, whether you are a younger person who's like still in school or maybe just recently out of school, or if you're older, even thinking about retirement. It's not game over. You can always start. There are ways to grow wealth over time, and the principles are the same. This is going to sound like a bit of a contradiction about what I just said, but approximately 90% of self-directed investors lose money. So those who have their own accounts are not hitting that like big increase over time. They're actually decreasing over time. So we got to ask, why is that happening? So we'll spend a bulk of this talk about why it's happening, but it's basically in behavioral investing. I got to say, behavioral is like a bit of like a code word for people that don't know what they're doing or making these like normal human mistakes. So sometimes when economists use it, I think it's like a bit condescending, but here I mean it like people being human and not knowing better, not having the tools. So let's go deeper into that. Investment biases are some of the major drivers behind this. So a bias, what we mean in this context, is an irrational belief, assumption, reactions, or interpretation of actual facts that make it difficult for you to make the right decision, even if it's like an evidence-based right decision. So things that intermediate between like the right thing to do and what you actually deliver on. And that's another way of being human. Some of the biases, complexity aversion is one that came up huge in the study that I did with the university. People just feel overwhelmed with the complexity of participating as a self-directed investor. You say the word equity, you say the word dividend, whatever it is, and as soon as that kind of nerve gets hit, they just sort of dissociate and don't want to engage with it. So one of the challenges of enabling people to participate in financial markets is like demystifying some of these terms, and also pointing out, like we said before, that you don't need to be an expert in like every aspect of the balance sheet. That's not necessary for most people. So complexity aversion is one that right off the bat, like most people don't participate because of that. A technical bias we call, I didn't come up with it, it's called the disposition effect. It's like an incredibly well-studied bias that you see happening across almost every asset class, from crypto to real estate, equities, Forex, everything, where people sell winning stocks. So if they bought something and it's winning, they sell it prematurely. But if something's losing, they don't sell it, like at all. And so what you have is these counterfactuals where you measure people's portfolios that they sold here, but then that asset went on to outperform, and they missed out on that big opportunity, while the assets that they didn't sell keep dragging down their wealth. So it's like pervasive across asset classes and is worth knowing. So we now measure that. We'll talk about that in a sec. Loss chasing is another one where people buy more of a losing asset. So on this side of things, instead of cutting losers, they'll put more money after that and keep decreasing their earnings because they're throwing good money after bad. And the list goes on and on and on. There's like 30 plus of these biases. At Prof Wall Street, we focus on the biases that are that matter a ton in terms of your performance, that a human can get better at, and they're identifiable in data. So it's meant to be the opposite of philosophy. It's not to be the sort of hand-wavy thing. It's like, no, this is a quantitative measure that you can get a specific metric on and improve over time. So I'll give you a couple examples later on. So if you're interested in these, our blog we go into great depth about all these biases. Please check it out. So I'm going to cover a few billion years, about 3 billion years, 4 billion years, in maybe about 45 seconds. So the biological roots of behavioral finance come from the fact that as humans, we are optimized to be in different environments. We are here having this seminar across the world. Yesterday we had people from all over the world. And this is, we're sitting in our offices in isolation. We live in big cities. We eat food that is not, that we historically didn't have access to, certainly not in abundance. You can make, that list goes on and on. So the challenge is that now we're in a modern environment and we have to operate in this new environment where we have brains and biological systems that are optimized for totally different tribal, smaller groups, high familiarity, in-group, out-group bias, all of those things, herding. All these things are acting typically against us when we are making investment decisions. I wish it were the other way around. The people were just these like mavens at automatically making the right decision. But as you see, if you open up, again, I keep referring to the Wall Street Journal, like there's, in the last week with all the tariffs and all the pandemonium, people are doing basically the wrong thing. They're buying and they're selling at the wrong time, and they think they're dip buying all the way down and catching these falling knives. It's a challenge. It's hard being human, especially when our technology allows us to make decisions really, really fast or make mistakes really fast. The word hormones at the bottom there is relevant because my area of expertise that I spent a lot of time researching was the impact of hormones, which essentially are the way that our body sends messages to the brain, or the brain sends it to distal tissue to affect the likelihood of a behavior. So I know it's sort of a technical definition, but I was curious, well, how would testosterone affect stock traders? And actually studied the impact of giving guys testosterone and see how they traded relative to people who got a placebo. And the guys that were trading on higher levels of testosterone created these huge price bubbles and massive crashes. And the placebo group had like nothing. They traded like robots, like perfectly. So I was very convinced that biology has an impact. And I think it's driven a lot of my interest in wanting to help people do a better job because of the obstacles that we face. So one of the specific challenges is asset selection. So there are thousands of possibilities. There's many individual stocks, there's ETFs, there's mutual funds, there's now crypto and all these coins. And I don't know if there's a family show or not, but there's like the SH coins, like the things that are going to go to zero no matter what. So people get these ideas and they just start going heavily into these assets. But what's missing is this like basic understanding of the distribution of assets. We'll get the distribution of return across asset classes. We'll get to that in a sec. But like, how do we pick the right asset? So there are companies out there, there are platforms, there are services that try to help us make that decision based on some evidence about the quality of the rules in assessing when to buy and when to sell assets. But by and large, people really struggle because it is really complicated generally as a newcomer to figure out, well, do I buy Apple? Everyone's talking about Apple. Do I buy NVIDIA? Everyone's talking about NVIDIA. Like, people are not equipped to deal with complexity just of selecting what to buy. Even harder is that, as I was mentioning earlier, people overtrade like crazy. And this is one of the, I think, early papers that got me interested in it is the more people traded, the worse their performance was. So overtrading just by itself is a key problem. And I can tell you that's true, not just because there's a bunch of papers written about it, because I replicated that finding with 500,000 traders, strong negative relationship between the quantity of trade and the performance. Sure, there are some people who are actually good at what they're doing and are generating alpha, true, but the majority of people, if you think back to that 90% of people who are losing, it's just through overtrading and reacting, and just degrading their portfolio performance to the point that they really can't come back from it. And then generating more kind of Hail Marys after that. So overtrading is a major problem. Emotions, we could spend a whole week just talking about emotions. But the challenge about emotions, by the way, the definition of the word emotion I think is interesting, that it originally came from the Latin emovere, meaning to move, remove, or stir up. So when we feel an emotion, it's something that we feel internally, but then we mistake it for a trade signal, we act on it like, I'm scared, I'm going to sell, I'm excited, I'm going to buy, when there's nothing intermediating stimulus and response, you've got a problem, because an emotion is not a trade signal. And that's sort of an uncomfortable thing for people to kind of absorb, because, well, if my gut kind of guides what I do in most things. And it's true, your gut is fantastic. If we look at that graph of human history, we're amazing at detecting social cues. We're amazing at that. We're amazing at smells and a lot of things that I could go on and on and on. But the thing we're not ideally suited for is responding in real time to a moving stock market. That's not what we're good at. And the faster we can appreciate that deficiency and build some structure around that to reduce the impact, the better and faster we're going to be. So I mentioned miscalibration. So overconfidence is a classic trait. Not to throw the guys under the bus, but statistically, guys tend to be more overconfident than women. Just being male is almost like a proxy in these research papers. Well, if you're male, you just assume that you're overconfident. It's not always true. I know very thoughtful males and so on. But this idea that I'm better than you, it's called like the better than average effect, drives people to enter competitions where they have like no chance of winning and make decisions because their own internal subjective probabilities are totally backwards. And they think that, yeah, I've got probably a 80% chance, but really have like a 3% chance. And that miscalibration is common. And the more objective you can be, the better off you're going to be. So to be overconfident is not good. To be underconfident is also not good. But to be well calibrated is critical. What I'm going to show here is, this is a graph, the return forecast. This is by BlackRock. And this is showing you what the return expectations are for different asset classes. And you're welcome to have this graph. You can find it on BlackRock's website. But the point of it is this, is that if you ask an individual what they think a specific stock is going to, it's not going to look like that. Like, they're going to have, oh yeah, it's going to the moon, it's going to go up 500% or 300%. And there's like no possibility of a zero in there. So you see individual investors are often miscalibrated and don't understand what kind of reality they're actually dealing with. The other one I would mention is investing platforms. You might say, Amos, why are investing platforms a challenge? And I'll tell you that they benefit from trading. They generally don't benefit from you making good decisions, even though a fair proportion of the revenue comes from what's called float. They want you to essentially trade as frequently as possible. They earn fees. In the States, as payment for order flow. So you have to think about whether the incentive structure for your trading platform is aligned with your incentives. So I'll leave that there. We'll do future talks about this specific topic. So there is lots of possible resources that you can use. So there's analysts, newsletters, the list goes on. As I mentioned, there's platforms that can give you recommendations and so on. But this problem persists. These newsletters have existed for a long, long period of time. So as I mentioned before, the challenge is that we have a broken investment process. What I mean by process is something that's robust and repeatable. And for most people, it's not very linear and it's not very repeatable, and it tends to be impulsive. So unless you have some sort of structure around your decision-making when you're making investment decisions, buys and sells, mistakes are probably likely to happen. So with so many challenges, the human solution for this is behavioral fintech. And what I mean by behavioral fintech is a guided investment process, portfolio upside analysis, something that analyzes you in a hyper-customized fashion. So if you have been making trades in the past, there's incredible opportunity now to understand your biases, which could also have a flip side. So some of the biases you might be very, very good at. So there's a mirror image. If you're very good at something or you're very bad at something, it's good to figure that out. And the worse you are at something, the more upside you have. So you have to think in a positive sense versus being worried about getting a bad diagnosis. It's actually a good thing to figure out what possible upside you have. Human coaching is critical, which we realize that's a lot of the reasons people go to advisors. So at Prof of Wall Street, we do provide that as well. And then we're building in AI to take advantage of like the huge upside or the basically the superiority of AI relative to some traditional software engineering principles. I'll give you a quick fintech timeline. So if you look at, so again, we're going to cram in 4,000 years in one slide. The beginning of fintech was just keeping track. Like how much corn does somebody owe somebody? Then moving on to money, and then using bonds, using fixed income in Italy. And then the fixation became more about faster and cheaper. So going back from the telegraph all the way to just recently, you're looking at PayPal and Stripe and Robinhood. Let's let people do things faster and cheaper. But at Prof of Wall Street, I think what's really missing the point is that you got to do better. Because what we've learned, the more people trade, the faster they trade, the worse their decisions. Like we're not talking about high frequency trading that you need milliseconds. We're talking about human beings that need a process, that need help. And behavioral fintech is that new category. There's this, I don't know how famous this is, but CB Insights put this out a few years ago, and I looked through every single one of these, and not a single one about behavioral fintech. So Prof of Wall Street's really drawing the line in owning that space of all we care about is enabling people to make better decisions and improving their wealth and growing their wealth over time. That's it. We don't make commissions off sales, none of that. The incentive is aligned with the consumer. That's all there is to it. And really, to our knowledge, nobody else is doing it, at least in the way we're doing it. So a behavioral investment process is what we have, and it's a guided tool that's available now, was released recently. And instead of showing you a demo, happy to do a demo and welcome everybody to meet individually after this. You might ask, well, does it work? What's the evidence, Amos? I'd say, well, we did a randomized control trial of this with the University of Cincinnati, and we found that there's a 21% annualized increase in the people that use our guided investment tool versus people that did not. There's like a placebo version. That's massive. That's not like nuanced. That's not this edge case. That's a lot. So we believe that it works. It's based on behavioral science, decision neuroscience, my background plus the great team that we've had at Prof of Wall Street to build something that takes a normal human with their strengths and weaknesses and flaws and turns them into a superhuman investor. That's the point, and that's really what we're trying to contribute. As I mentioned, this whole upside analysis, what do I mean by that? What we do is we analyze trade data, and then we find out where you have these patterns. And this specific one's called the invisible portfolio, and it measures the performance of assets after you've sold them. And a lot of people put a lot of effort into choosing assets, but they don't do a good job at their selling decisions. And so what you want to see is that your portfolio is higher than your invisible portfolio. In this particular example, you could see that the red is the portfolio, but the invisible portfolio, those sold assets actually went on to be quite good. So for this particular client, not so good. The sell decisions need some work. And then loss chasing is the idea that when we're in a losing position, we keep buying. Well, is that generating value or is that destroying value? Some people are these amazing dip buyers, and then in a losing position, I'll buy more, and then boom, they go up and there's mean reversion. So what you want to see is what you're seeing in this case of loss chasing adding to the portfolio. So the blue line's above the red line. And a revision's coming soon. We'll show you kind of in real time what's going on. But these are the things we measure, and these are things that make a big difference, humans can improve at, and are easily detectable in data. So this pre-trade checklist, I want to make sure we have a few minutes to chat. This is like kind of the paper version of our digital product, available for free. Please use it. Start to have some sort of process. I mean, you probably have a process already, but maybe enrich that process and try to adopt best practices when making investment decisions. So the final answer is, should I trust with myself, my money? I believe, and we believe, the answer is yes, but with the right tools that are designed to help you do a better job, not just to get you to trade more frequently. That's really not the right idea. So we call it augmented self-directed, which I think is the key for most people. And that's the second to last slide. I want to make sure we have a few seconds to chat. I know we have about 4 minutes here. So yeah, the whole idea came up from this critical question, from personal experience, from data, from research, from clients we work with. I think it's time to do a seminar on this. And do you guys remember? Yeah, so we did some blog posts on this, but do you remember that kid at the very beginning? Do you remember we talked about the kid came in with the jar? And the teller said, well, you could do this and make more money, and you could just inhibit the desire to put in this more liquid. Well, that kid went on to get a PhD in behavioral economics and neuroeconomics. And that kid is me 10 years ago, after the first time somebody ever called me Dr. Nadler, with a lot more hair. And that's my advisor, Paul Zach, just a mountain of a man, great guy that was supportive to me. Yeah, can't thank him enough for helping me learn this complicated field and be able to apply it. He's also an entrepreneur with a cool company. So I want to end on that note. The next talk is going to be how to be the best investor I can be. That's our next topic. And that is all I have. So Lex, did you have any other housekeeping before we go to Q&A or discussion?
I just want to thank everyone for being here. Of course, reach out if you want any additional information, if you have any additional questions. We're always willing to set a meeting up to chat. So, but again, thank you everyone for attending. I will be in contact the next few days with a survey that is super helpful if you guys are able to fill that out, as well with a little bit of other information. So.
All right, guys, questions, ideas, any good finance jokes, anything. We're all ears. This is the discussion time. Don't be shy.
A question here would be, as you look at where you want Profit Wall Street to go and thinking through behavioral finance and all, first off, just great information that you shared, and thanks for doing this. Really interesting about how financial advisors, a lot of them aren't maybe as helpful as they would be branded to be. So with all that information in mind, where would you like to take Profit Wall Street as far as like filling the gap? And you've kind of mentioned, you've kind of gone over that. But I guess from the perspective of like, if I'm an individual human, what do you want the interaction to be? Do you want there to be more of a human element or just total, app and behavioral, like not total robo, but what do you hope the average person does and interacts with in the future with Profit Wall Street?
If I were to sum it up into one word, it would be transparency. Like, we take raw data that's like completely opaque and ununderstandable to people, and we make sense of it. So whether that is you're working with an advisor, there should be an intermediation layer that shows the individual like exactly whether that advisor is taking care of them in a manner that they should be. And we have modules that do that. We can calculate the performance, we can calculate the fees, we can do all sorts of things that are opaque to people when they look at their statements. So I think transparency is critical in those relationships. Like, we're not trying to be financial advisors. We're just trying to make sure that advisors are providing value to their clients. From the self-directed perspective, it's somewhat similar, where if somebody's making decisions, we can provide that person with transparency about their particular strengths, their weaknesses. Those weaknesses can be turned into strengths. And most people have no idea what to call it. They have no idea the impact or how to solve it. So we try to address those three things through the technology. And ideally, we'd love it to be built into trading platforms and other great services. Whether it's APIs or another platform like trading platforms or any of the other ones that are out there.
Awesome, thanks.
Thank you. I'm seeing people on this call who always have good questions and today are quiet. I'm not sure why. You guys always have good questions. Okay, well, I know we're at time and we want to be punctual. So if there's no other questions now, you can certainly reach out later. Lex will follow up with the certificates, and there are resources that we'd love to see which one would be most helpful to you. And again, thank you so much for making time, like middle of the day, and joining the session. We're going to do more. And yeah, we love to just basically create transparency and create superhuman investors using financial technology. And that's it for now. Till next time.